Hello student, today we will be discussing the new chapters which has been introduced here in your syllabus, and that is chapter 6 of your study module, that is accounting and reporting of financial instruments, and that is based on the Ind AS 32, Ind AS 107 and Ind AS 109. At the first instance, I would like to clarify you that you have no Ind AS. The Ind AS 32, 107, 109 are not in your syllabus. This is the chapter 6 of your study module, which was earlier based on the AS 30, 31, 32. Because those 30, 31, 32 were not notified by the government, and now the new Ind AS has come, and they have some slightly different treatment of the financial instruments. Therefore, the Institute of Chartered Accountants thought that we should update this chapter of accounting and reporting of the financial instruments. So now this chapter has been updated by the ICAI based on the Ind AS 32, 107 and 109. Again, I will reiterate that Ind AS 32, 107, 109 as such are not in your syllabus. This is what is in your syllabus is accounting and reporting of financial instruments, and this chapter is based on the Ind AS 32, 107, 109. I would again tell you that the Ind AS are not in your syllabus for May 2016 exam. Only one chapter, there is another chapter there, which was earlier the introduction of IFRS, their comparison with our accounting standards and the US GAAP. That chapter has been withdrawn, and in place thereof the chapter introduction of Ind AS, the difference with the existing AS, and the carve outs and carve-ins were introduced. Again, there are no Ind AS, and there are around 39 Ind AS which has been notified by the central government. Those are not in your syllabus. It's only the one chapters which is in your syllabus. Today we are discussing the chapter 6 of your study module, which is based on name is accounting and reporting of financial instrument, and that chapter name is the same, but there is a revision in that chapters, and that revision is due to the Ind AS 32, 107, 109. So that's the important thing which you have to keep in mind. Generally, the students have got a confusion that you have a Ind AS in the syllabus. No Ind AS in the syllabus. So please, whatever is written, announced by the Institute of Chartered Accountants, they have given you what is in syllabus. They are syllabus from AS 1 to AS 29. Then you have a chapter 6 which is based on Ind AS 107, 32 and 109, and you have another chapters introductions of Ind AS and the carve outs, carve-ins and differences with the existing AS. So that is what pertaining to the Ind AS. Ind AS as such, 39 Ind AS are not in the syllabus. So you will be asked questions depending upon that one. So in this case we will be in these chapters you have the financial instruments, reporting and accounting, and that accounting is based on the three Ind AS. Ind AS 32 which talks about the financial instrument presentations. There is one Ind AS 107 which talks about the disclosures of the financial instruments in the financial statements, and there is a third Ind AS which is Ind AS 109 which talks about financial instruments, and that is pertaining to the recognition, measurement, impairment and hedge accounting. So that is what you can say that the 109 is important, but you need not to remember this Ind AS number. You should not think about this Ind AS 107, 32, 109 because Ind AS as such are not in your syllabus. But these are whatever the contents in these chapters we are discussing, contains is in these three Ind AS. Now the questions arises, what is financial instruments? When we are talking about financial instruments, what is financial instruments? The definition is given in these NDS, and NDS definition is in 32. And there they talks about the presentations. So what is the financial instruments? Generally, when we talk about the financial instruments, the pictures comes in your mind that it may be an investment, some capital market instruments, and it may be something like that, you shares, debentures, and like this. But in fact, the students, it is not limited to that one. It includes the financial instrument, includes the financial assets and financial liabilities. Now, what are the financial assets? What is the financial assets? Financial instrument is any contract that gives rise to the financial asset of one entity and financial liability or equity of another entity. Because when we are talking about the financial instrument, it includes the financial assets and financial liability. Now the question is first that what is the definitions given of this financial instrument in these standards? It says that any contract that gives rise to the financial asset of one entity and financial liability or equity of another entity. So in one entity it is a financial asset, in another entity is a financial liability, or it may be the equity of another entity. So generally when we are talking about the instrument, it includes financial asset as well as financial liability. Now take an example that somebody sold the goods, X Limited sold the goods to Y Limited. So X Limited will show if it is sold for 50,000 rupees. So X Limited will have a debtors of 50,000. So Y Limited will have a creditors of 50,000. So there is what this chapter of financial instruments say, that any contract gives rise to financial asset of one entity. There is one entity, that is the X Limited. When it's make a sales on a credit, it gives rise to debtors, and that is the debtors. Debtors is a financial asset of X Limited, and then it is also the financial liability of Y Limited. This Y Limited has got a financial liability. So the definition of the financial instrument is that financial asset of one entity, this is a financial asset of X Limited, financial liability of another entity, that is a Y Limited. So that is the financial instrument. Now the case but it does not talk only of this one. It says in that another one, that it says the financial liability or equity of another entity. So what will be that situations? Suppose here the X Limited, instead of selling the goods on credit, it has invested in the shares of Y Limited of rupees 50,000 shares of Y Limited, and it has purchased from the market, maybe that its nominal value may be suppose 5,000, but they have purchased from the share market at 50,000 rupees. Now the question is that X Limited will show it as an investment of rupees 50,000. Investment of rupees 50,000. What about Y Limited? Y Limited has already sold its equity in the market, and here it will not be the liability. Here the Y Limited may be showing in the equity share capital of 5,000 rupees. Maybe it has sold at that time at the par value, then it may be showing here 5,000 rupees as a equity at the nominal value. That will be the paid up capital. So what this the financial instrument definition says, any contract that gives rise to financial asset of one entity, it is a financial asset of X Limited because it has made an investment of 50,000 in the shares of Y Limited. Now for the Y Limited, it is not a financial liability. For the Y Limited, it is a equity. It's an equity share capital of Y Limited, and that's why still it is a financial instruments. So that is the meaning of the financial instruments in this case. Now the question is that we have explained to you what is financial instrument. Now that question arises, what it say that it is a financial asset of one entity and the financial liability of another entity or the equity of another entity. Now what is the financial asset as such, and what is the financial liability? and what is the equity. These are the three terms which we are going to explain. I think the students, these are the three terms which are very important from the examination point of view, and maybe that the questions is surroundings on these three terms every time in the examinations, because this chapter, when they have written, the ICI has written that only the preliminary conceptual questions should be asked in the exams. It will not be that you are required to be expert in this particular chapters, and the questions of expertise level will not be asked. It will be at a preliminary one. So preliminary one means that you must know what is the clear-cut definitions of financial asset, financial liability, or equity. Now we are now talk about the financial assets. It says that cash is a financial asset. I think there is no definition of it, and it says that cash is a financial asset. Cash is a financial asset, and cash is a financial asset. Equity of another entity is a financial asset. So here they have just given a particular name. Cash is a financial asset. No definition yet. Equity of another entity is a financial asset, because if the X Limited has made an investment in the equity of Y Limited, the X Limited is showing it is a financial asset. So it is the equity of another entity. It's a financial asset. But then comes to the definitions. Another definitions, principles which has been laid down and which has been defined now. What is that? Contractual right to receive cash. Contractual right. That's a very important. The contractual right to receive cash will be the contractual right to receive cash is a financial asset, or another financial asset from another entity. So that's very important, that there must be a contractual right. There should not be any legal right for it, and that will be a financial asset. Or another financial asset from another entity is a contractual right to receive cash. That will be a financial asset. Just like in case of a debtors, as I gave an example, that X Limited sold the goods on credit to the Y Limited, and the X Limited has shown the debtors of 50,000. Now it's a contractual right. Now the X Limited has got a contractual right to receive 50,000 from Y Limited, because it has to pay. It has sold the goods on credit and it's a debtors receivables. It has a contractual right to receive cash. But suppose if there is no contractual right to receive cash, they say they have a contract. We are selling you goods of 50,000, but when these debtors becomes due, that fellow the Y Limited may pay it by another. They can say that I haven't got a money cash, but please take I have got some investment of some companies, and please take those investment, and that is equivalent to 50,000. So to receive, he is not receiving, X Limited is not receiving the cash, but it is receiving the another financial asset. So that is also this contractual right to receive cash or another financial asset is a financial asset. Now, what is important is a contractual right. I told that there should not be any legal right. Legal right is not included here. If there is a legal right to receive cash, is not a financial asset. That's very important, which you have to remember. The another is to exchange financial assets or financial liabilities with another entity under conditions that are potentially favorable to the entity. It says that suppose you give somebody, in a simple term, which may not be, maybe little bit hypothetical, but just to make understand to you what does it means. That if you give somebody 500 rupees and then you take and you will get 700 rupees against this. So it is under the favor, because by giving 500 you are getting 700. That's on the exchange of financial assets with another entity under conditions that are potentially favorable to you. It's a favorable to you because you will be getting 200 more. So that 200 is a financial assets. So it's a potentially favorable terms. But where this definitions applies, it generally applies in case of a derivative instruments, that exchange of financial assets or financial liabilities with another entity. It may be due to certain restructuring of debts, because suppose it's a case of a bank, they have given a loan to certain customers, and that customer is not able to make a payment, and the loan amount is 5 lakhs, interest rate on that is 10%. They are not able to make a payment of that 5 lakhs. They are in distress. The interest rate is 10%. then there was a discussion between the bank and that customers, and it was agreed that we should restructure that debts. And in that case, that they say that instead of the 10% you pay interest, now the 12%, and we will extend the period of repayment of the debt from 5 years to 10 years. But you have to pay more interest on that one. Maybe if from the point of view of the bankers, it is the exchange of assets. There are old assets gone, the new assets of the loan of 12% has come, and that term may be more favorable to the company, and therefore it will be that whatever will be the difference, because the bank has given less, it has got more under that restructuring conditions. So that is the condition that are potentially favorable to the bank, and then it will be called that difference. Suppose in the future they will be getting against 5 lakhs, they will be getting more interest of suppose 50,000 more, then 50,000 is again a financial assets. So that 50,000 is a financial, because at a favorable terms you have exchanged one asset to another assets, and you are getting more on that one. So that's the meaning of the financial assets. So these are the examples. Now we have already told you that the cash, the investment or the equity of another entity, these are financial assets. And then there was a definition. Definition was contractual right to receive a cash or another financial asset, or exchange of financial assets or liability at a favorable terms. So that is the financial assets. Now we apply this definition to these assets which are appearing in the asset side of the balance sheet. So what will be that? Cash, as we have told, it is a financial asset. As we are told, cash is a financial asset. Investment is a financial asset, that we have already discussed. Now the question about loans. It is not written there. It only says cash and investment. And the other thing will come under the definition contractual right to receive cash or another financial assets. Now take a case of a loan. If the company has given a loan to anybody, there is a X Limited which has given a loan to its employees of 50,000 rupees, then X Limited has got contractual right to receive back this 50,000. Maybe the interest rate may be 8% or 10% along with the interest. So it's a contractual right to receive cash, and that comes within the definition of the financial assets. So loan is a financial asset by that way. Receivables, as I already explained to you, because there is a contractual right to receive cash from the debtors, so it's a financial assets. So these are the financial assets in this case. Now, what are the other examples? Because these are the assets. In the asset side, you will find cash, you will find investment, those are financial. You find loans, it's a financial asset. You find receivables, financial asset. Now, what inventory is a financial assets? Now you apply the definition to that one. What it says? Cash, investment, contractual right to receive cash or another financial asset. Is it inventory is coming within that definition? No. Because there is no contractual right to receive cash. If the X Limited has got an inventory of 5 lakhs in its godown, it has no contractual right to receive cash from anybody. It is just lying. This contractual right will arise only when this inventory is sold to somebody on credit, and then there will be a contractual right to receive cash. So till that there is no contractual right. So inventory is not a financial asset because it does not come within that definition. What about the prepaid expenses? Prepaid expenses is a financial asset or no? Please apply the definition. Definition says contractual right to receive cash or another financial asset. Prepaid means just like you have made a prepayment of insurance. There is a prepaid insurance. So whether you will get a cash at the end of the period? No, because there will be adjustment of it. You will not get a cash back. So prepaid insurance, because it does not come within the definition, contractual right to receive cash or another financial asset. What you will be getting? You may be getting the services from the insurance company for that one. And you will make an adjustment of the prepaid insurance when it becomes due. So neither cash comes nor another financial asset comes. And therefore, it is not a financial asset. Now refund of taxes, whether it's a financial asset? Please apply again the definitions. What is the definition? Contractual right to receive cash. As I told you, it must be a contractual right to receive cash. Contractual right. Refund of taxes means you have to take 5 lakhs of refund from the income tax departments. It's a refund of tax. You have shown in your balance sheet refund recoverable from the income tax department. The question is that is it a contractual right to receive cash? Nevertheless, it's not a contractual right to receive cash. It's a legal right actually, because under the income tax law, it is your legal right to receive this much of refund from the income tax department as per the income tax provisions. So it is not a contractual right, and therefore even it is shown in the asset side, you will be receiving a cash against it, no doubt, but because it is not a contractual right to receive cash, rather it's a legal right to receive cash, and therefore it is not a financial asset. So refund of taxes, not a financial assets. Now what about the fixed assets? Whether the fixed assets are the financial assets? Please apply again the definition. Contractual right to receive cash or another financial asset. Have you got any right, contractual right to receive cash against the fixed assets? No. Have you got a right, contractual right to receive another financial asset against the fixed assets? No. If it no, then it is not a financial asset. So that is what it says, that it is not a financial asset. Now, dear students, what we have discussed is a financial asset, and I hope it is clear to in your mind that what is a financial asset, because that will be the one of the main point will be in the exams, and to start and to understand the chapter subsequently, these 3 terms you have to very much clearly understand, because the accounting treatment depends upon this, whether it's a financial asset, whether it's a financial liability or equity. Until unless you understand these 3 terms, it will be difficult to understand the subsequent accounting treatment of these 3. You have to first clearly distinguish, clearly understand these three terms. So we have explained to you, I have explained to you the financial assets, and I hope it is clear in your mind now. Now the question arises, what is a financial liability? What is the financial liability? The definition given in the financial liability is contractual obligation. You see, when you are talking about the financial assets, it was a contractual right. Now, instead of right, it is a obligations. Contractual obligation to deliver a cash. There what was receiver a cash. In the case of financial asset, it was a receive cash, but it is deliver a cash. Another financial asset to another entity. It is a contractual obligations of an entity to deliver a cash or another financial asset to another entity is a financial liability. Now take an example. I told you that the creditors. Creditors X Limited has to pay to Y Limited, suppose 1 lakh rupees. X Limited is showing it as a creditors. These creditors, now it's a financial liability. Why? We will apply this definition. Definition of contractual obligation to deliver a cash. Yes, X Limited has a contractual obligation to deliver 1 lakh rupees to Y Limited. So therefore it's a financial liability. So creditors is a financial liability. Or another financial asset. Suppose the X Limited say at the time of maturity or before that one, sir, I will not have a 1 lakh rupees on that date. I will be giving, I have some investment of rupees 1 lakh. I will deliver you a 1 lakh. Those investment to you, I will give you. Instead of giving a cash, I will give you investment. So that is investment in nothing but another financial asset. And it is giving to another entity, that is Y Limited. It's very important that you can't give yourself. And there has to be 2 entities between these the transactions. If there is only one entity, one department to another department, then it can't. The conditions of another entity is not satisfied. So it can be that if one department owes to another thing to the another department, that's not a financial asset. It may be a financial asset to one department to another department, but those departments are not the separate legal entities or separate accounting entity. Sometimes if they are a separate accounting entity, they may treat like so. Now that's the first definition. The first line of the definition is contractual obligation to deliver cash or another financial asset, and that I have explained to you. Again, if you recall about the financial assets, it was that exchange of financial assets or financial liability to another entity under conditions that are potentially unfavorable to you. The word is unfavorable. When you were talking about the financial assets, the word was favorable to the entity. That's the only difference here. Otherwise, everything was the same. So, these are contractual obligations to exchange financial assets or financial liabilities with another entity under conditions that are potentially favorable to the entity, unfavorable to the entity. As I talked at that time, when the bank has given a loan to a customer, so 5 lakhs rupees at the interest rate of 10%, customer is not able to pay in time, and the bank and the customer agreed that, okay, now they will increase the interest rate to 12% and then they give a further 5 years time to make a payment. Now, in that case, the bank has got settled the things, one financial asset of the old loan of 5 lakhs at 10%, now the 5 lakhs at 12%. So it's potentially favorable to the bank, and that was the financial asset. That difference was financial assets. Now, suppose take a reverse case here. The bank is having given a loan to the customers of 5 lakhs rupees at 10% interest. Customer is not able to pay it. It says that my position is very weak financial and I will not be able to make it. They say, no, what to do then? They say, yes, we will reduce the interest rate from 10% to 7%. We'll make an installment or may extend some period also of the loan repayment period. Now, by these calculations, for the bank, it is a exchange of financial asset. There was a financial assets of 5 lakhs at 10% interest. Now they have exchanged it to 5 lakhs at 7% interest. Certainly, the terms are unfavorable to the bank, and therefore it becomes a financial liability to that extent. So that's the meaning of the exchange of financial assets with financial liabilities. So that's the financial liability, and there again say a contract that will or may be settled in the entity or equity instrument is a non-derivative for which the entity may be obliged to deliver a variable number of the entity owns equity instrument, a derivative that will or may be settled other than by the exchange of fixed amount of cash or another financial asset for a fixed number of entities own instruments. So what it say that a contract that will or may be settled in entities own equity instruments. This is sometimes what happens, that company is issuing its own equity shares. They are not having suppose they have to pay something, they say that we will be issuing to your own equity shares. They have to pay, suppose there are creditors, X Limited has got creditors of 1 lakhs. Either it will settle it by cash or by another financial asset. But they say, no, neither I haven't got a cash nor the financial assets. But I want to give you the equity of rupees 1 lakhs because I have to pay you I have to pay you 1 lakh. So as a creditors, you are my creditors. I have to pay you 1 lakhs. I haven't got cash or another financial asset. I will give you equity of by issuing my shares. Dear student, you should not always think that the shares, if the company is paying by its own shares, still that is a financial liability. But sometimes it may be a financial liability or it may not be financial liability. What if it is a non-derivative which the entities may be obliged to deliver a variable number of entities own equity shares, derivative that may be settled other than the fixed amount of cash or another financial asset for fixed number of equity shares. So the situation whether it's a financial assets or financial liability, that will depend upon this one. Whether it's a derivative contracts or a non-derivative contracts, we'll discuss it a little bit later, because when we'll discuss what are the derivatives. Now, dear student, as we are discussing these chapters, with regards based on the Ind AS 32 Ind AS 107 and Ind AS 109. This is chapter based on this. When we formulated this Ind AS 32, we have made certain carve-outs. We have made certain carve-outs which I have already discussed. When we were discussing that newly introduced chapters of introductions to the Ind AS. What is that carve-outs? It says that carve-outs means we have made certain changes in the definition of the financial liability or equity. What it said? You see, there is when we are talking about the financial liability, so in the Ind AS 32 we made certain changes, and that change is important, material, and that's why it is called a carve-outs. What is the meaning of carve-outs? Means we have made a certain important changes in the IFRS. We have tried our best that the IFRS and our Ind AS are the same, but due to some reasons, maybe suitable for our countries, under the economic circumstances prevailing, yes, the customs, traditions, the market situations here, we have made a certain important changes that we are calling it a carve-outs. So, what is the carve-outs there? There is a definitions of the equity instrument has been changed, and in case of FCCB, the equity conversion option embedded in a convertible bond denominated in foreign currency to acquire a fixed number of entity-owned equity instruments is an equity instrument if the exercise price is fixed for any currency. Dear student, here it says that if there are FCCB, FCC means foreign currency convertible bonds. Foreign currency convertible bonds. Foreign currency convertible bonds means that you have issued a bond for $100 in suppose in the US market. $100. And it was issued in 2015. You have promised that within 3 years this bond will be converted into 4 equity shares of that company, which is an Indian company. Its one equity share is rupees 10. But because the market price is more, that's why they say that $100 bond will be converted within 3 years at the option of the holders. Holders means who have purchased those bonds in the US for $100. They are given an option by the company that you can convert it within 3 years in 4 number of equity shares. So what is the amount of bond is fixed, that's $100. Number of equity share also fixed, that is 4. Fixed. What is fixed? US dollar 100 is fixed. 100 is fixed, and you will get in exchange of it 4 equity shares. So it says that everything is fixed. Our Ind AS 32 says that equity instrument if exercise price is fixed, exercise price is there. They say that for US dollar 100 you will get 4 shares. So exercise price of $100 for 4 shares is fixed, and they say it is not a financial liability, it is an equity. Even it is issued, it will be converted maybe in 2018, you issued in 2015, and in 2015 itself, because it is nothing but that you have got a money, share application money in advance, and that will be considered a part of equity, not the liability. It is okay, but there is a conversion option in between. As far as the FCCB is concerned, that's fine. But what the IFRS says? IFRS says that because you have issued the currency foreign currency convertible bond in the foreign currency, that is in US dollar. Your functional currency or the currency is rupees. In India, your functional currency is rupees. So you have, and you will be giving them as shares in a rupee term. That is a par value is 10 rupees. They are being sold in the equity market here in India in rupees. So you have issued a FCCB in the currency other than the functional currencies. Your functional currency is rupee. You have issued the FCCB in dollar, which is not your functional currency. The IFRS says that if it is so, if it is a functional currency of you have issued the foreign currency convertible bond in your functional currencies, then fine, it's a equity. But there is a derivatives between them. Derivatives because you have issued the bond in dollar, you will be converting into equity in terms of rupees. So there will be a certain difference between the exchange rate of today of 2015. You might have thought, yes, today the dollar is 60 rupees in 2015. So you will be giving means that $100 means it will come 6,000 rupees, or for 6,000 you will be exchanging 4 shares. 4 shares means for 1 share 1,500 rupees, because in the market your shares is being sold maybe around 1,600. You want to give them 1,500. Tomorrow at the time of exercising the conversion options by the shareholders, bondholders, on that day the dollar goes to 70. Now, when you will be cancelling this debt by your equity, then it means for 7,000 you are giving them a 4 shares. So per share price comes in the rupee term 1750. Whereas you thought that it will be 1,500. At the time of giving you thought that it's 1,500. Now you are giving at 1750. Because your functional currency is rupee, the bond are not in functional currencies other than rupees. And because of there will be bound to be a difference because of the conversions. This currency, because they are issued in foreign currency, and that's why it says that there is a conversion option. It is embedded in the convertible bonds, and therefore in that case they say that conversion option, not the bond as such, the whole bond are not the equity or that liability, because balance is the equity. They agree. In the IFRS they say there are 2 portions here. One portion is that FCCB amount, suppose it is of 100 rupees US dollar. No doubt they are saying that $100 you can show as a equity, because you have received a money in advance for 4 shares. But there is a conversion options that the holder can opt for conversion. Option is with the holder. The company has got a liability, obligation to issue the shares if the holder exercise the options. So there is a conversion option which has got the value. And that conversion option, if valued, it's a liability. It is not an equity, because it is the obligations of the company to convert the bond into shares if the holder exercise the options. So that's an obligation. That obligation, you have to value the conversion options, and that conversion options is a liability, not the equity. And that's where the difference arises. We say that no, whole amount, the FCCB amount and conversion options, both are equity. Whereas the IFRS says, okay, FCCB amount $100, no doubt, it's a equity received in advance, and so it will go to the equity portion. But the conversion options inbuilt in that one is not an equity, it's a liability. Whereas we say it's an equity also. The converged option is also equity. So that's where there is a difference, and then it is called a carve-outs. So that's what I have explained to you in this one. In case of FCC, the number of shares convertible on the exercise of the options remains fixed, and the amount which the option is to be exercised in terms of foreign currency is also fixed. It's fixed for fixed. Merely the difference on the currency should not affect the nature of derivatives. The option, further the fair value of the option is based on the fair values. Why we have done, this is the reason. Why the India is saying that no, there is a no, we are not, even the option, derivative options, foreign currency options inbuilt in that FCCB is a equity, whereas the IFRS says it's a liability. And why we are saying equity? Because that's the explanation given. If there is a decrease in the share price of fair value of derivative liability, it will decrease this one. So these are the explanation given by formulator of this accounting standard in India. They say no, it will be it is a equity. That option will not be valued and will not be shown as a liability. Now, what are the examples of the financial liability? We have given you examples of financial assets, but what are the examples of financial liability? Examples are debentures. Debentures is a financial liability. Why? There is a contractual obligation to deliver a cash, because if you have issued a debenture on 2010, they will be payable, they will be redeemed in 2015. So in 2010, you have a contractual obligation to pay cash at the end of 2015. So it comes within the definition of financial liability. Creditors, as I explained to you, is a financial liability. Forward contracts. Forward contracts may be financial liability or financial asset, both. If it is unfavorable to you, it is a financial liability. It is favorable to you, it's a financial assets. So forward contract, which is a derivatives, is a financial liability, or it may be a financial asset also. If it is favorable to financial asset, unfavorable financial liability. Redeemable preference shares. That's another area where the remarkable change is going to come due to these standards. It was earlier also in 30, 31, 32. Dear student, whatever we have discussed till now, these are all definition, everything was written and they are the same as 30, 31, 32, except the carve out which I talked about, the FCCB. And that is not also very material also. Otherwise, till this time, what we have discussed, it is exactly the same as we are having in 30, 31, 32. Now, these are all a financial liability. We are discussing redeemable preference shares. In India, generally, the redeemable preference shares, because they are preference shares, they are shown with the shareholders. This is shown with the shareholders' money. It's a shareholders' money. It belongs to the shareholder, and there are two types of shareholder: equity and preference. So amount due to the shareholders, and therefore we are showing it in the equity portion. Equity portion. Please don't confuse it with the equity share capital. Equity means which belong to the equity shareholder. Reserves and surplus is a part of the equity. So anything which belongs to the equity shareholder is a equity portions. Now the question here arises because these preference shares are a share capital. We are showing it under the head share capital, shareholders fund. When we are making a shareholders fund, it includes the share capital, preference share capital also. But you understand, after these standards, preference share capital will no more be the share capital. It will be a liability. It will be shown in the liability. Because when these Ind AS will be implemented for those companies which are going to be implemented from 1/4/2016 for the companies having a net worth more than 500 or 500 crores, 500 crores or more, they will implement the Ind AS from 1/4/2016, And if they have a preference, redeemable preference share, it will be shown in the liability, not in the shareholders fund. And that will be remarkable change now in the structure of the balance sheet. The share capital will turn up to the loan. You will have a change in debt equity ratio, and we have a subsequent more changes in the profit and loss statement also. So why the redeemable preference shares is a liability? Why? Because the definition of the liability is, we say contractual obligations to deliver the cash. Contractual obligation to deliver a cash. What happens? What happens? In case of a redeemable preference share, you have issued a redeemable preference shares of 10 years in 2010. They will be redeemable in 2020. So in 2020, you have to pay the cash. You have an obligation to pay the cash to these people who are having a preference shares. So having not got a contractual obligation to deliver cash, if it is so, it comes within the definition of the liability. Contractual obligation to deliver a cash. And therefore, from now, when this Ind AS 32 will be implemented, and they will be implemented for those companies having a net worth of 500 crore or more from 1/4/2016, and at that time, these redeemable preference shares will be put as a liability, not as a shareholders fund. So that's because you have a contractual obligation to deliver a cash. That's come within that definition. You have no contractual obligation to deliver a cash in case of equity shareholders. Because equity is a residual. Whatever is left, it goes to the equity shareholders. This is not the case with the redeemable preference shares. You have to pay a certain amount of money, you have to pay back to them. And when you have to pay them, what is the difference between the loan and the redeemable preference share? Like a debentures. You have to redeem those debentures after 5 years or 7 years. Just like that, you have to redeem this redeemable preference share after 10 years. But suppose the preference shares are irredeemable and they are redeemable only at the time of liquidations of the company, but the amount is also not sure that how much they will be paid. How much they will be paid will depend upon at the time of liquidations, that whatever amount is available to the company after paying the external debtors, then the preference shareholders will be paid. In that case, they are not redeemable. There is no contractual liability to pay cash, contractual obligation to pay cash, and therefore, if they are irredeemable preference shares, only redeemable or only payable at the time of liquidation of the company, then they may be treated as an equity. They will be treated as equity. But till they are redeemable, they will not be treated as a part of the shareholders fund. It will go in the liability side. So that's the biggest change which will come after implementation of these standards. So that's redeemable preference shares. Whenever in the exam you will say it is a liability. So this is the financial liability. So this is a new addition to the liability, redeemable preference shares. It's a financial liability. And therefore, when we pay the dividend on the preference shares, redeemable preference shares, how it will be treated? Preference share, if you are paying the dividend on them, the preference share capital itself is a liability, then whatever you are paying is an interest. Then the dividend will be treated as interest. And interest will come as an expense in the profit and loss account instead of in the appropriations part. It will be part of a net profit computations, which we are not doing at present. So it will change the net profit also. It will change the debt equity ratio also. It will change the return on capital implied also. So there will be a lot of change on that one. Now, that's the interest will be no doubt under the tax laws. This dividend, if even we are showing as in expense, they will not allow it as an expense. But that's the income tax law. There are so many other things they don't allow. Some income they don't treat more income rather than what is written in the financial statement. So that's the income tax law. But what the accounting will be, that the dividend will be treated just like an interest. Now the examples of non-financial liability. We have given an example of a liability. Now what is the financial liability, which are not a financial liability? Equity shares, own equity, that's a equity, not a liability, as we have explained. Commodity exchange contract is not a financial liability. Commodity exchange contract means you are exchanging two commodities. You are giving 100 kg of wheat to 110 kg of rice. You are exchanging these two contracts you are having. And you are really exchanging it. Means one person will deliver 100 kg of wheat, another person will take the delivery and it will again deliver in exchange of it 110 kg of rice. So it's a commodity exchange contract. And this settlement is done by actual delivery. It's not a financial liability. It's not a financial liability of that person who have to obligation to deliver wheat or deliver rice. But do you understand? If they say no, in the future when the settlement takes place, they say that 100 kg of wheat is 1 kg is of rupees 50 rupees. Here the rice is 40 rupees. Then the total price comes of rice 4,500 and the total price of wheat on the settlement date comes 5,000. They say yes, okay, please, this fellow will say, please give me 600 difference. 600 difference. If they have an intention to settle in net, then it is a financial liability or financial asset. There will be a financial liability here in that fellow. There will be a financial asset for this fellow. If it is settled in net, if the intention in the beginning was to settle it net on the date of settlement, then it becomes a forward contract. And that becomes a financial asset or financial liability, depending upon that whether it's favorable to you or unfavorable to you. So, dear student, you have to be very careful. Commodity exchange contracts are not the financial liability. They become a financial liability or financial asset if they are settled net. Tax payable, not a financial liability, because as I told, it's not contractual obligation to pay cash. It is a legal obligation to pay cash, therefore it's not a financial liability. Warranty obligation is not a financial liability, in spite of the fact that it is shown in the liability side of the balance sheet. Why it is not a financial liability? Because the definition is contractual obligation to deliver cash. Is there any contractual obligation to deliver the cash in the warranty obligation? No. No delivery of cash is done. What is delivered is the services. The company which has given a warranties, they will be delivering the services. They will delivering the material to correct, because if the one company has sold televisions to somebody and they say that if these televisions get, if there is any problem within 1 year, we'll do the maintenance free of cost. So the company has got a warranty obligations to correct it, to repair it free of cost within 1 year of sale. If it is so, the company has got a warranty obligation. They might have made some warranty provisions for it, may be shown in the liability side of the balance sheet, but it is not a financial liability. It is a liability, but it's not a financial liability. And if it is not why it is not a financial liability? Because it does not come within the definition of the financial liability. Definition of the financial liability is contractual obligation to deliver a cash. Under the warranty obligation, there is no contractual obligation to deliver cash. Rather, there is a contractual obligation to repair the goods sold. And repair may be due to rendering of services, rendering of goods, selling of the goods, by delivery of the goods, but not by contractual obligation to pay cash or another financial asset. So, warranty obligation is not a financial liability. Insurance contracts are not a financial liability because they are covered by another NDS that is called NDS 103. So you need not to worry because again under the insurance contract there is no contractual obligation to deliver cash. So and they have a different provisions. Therefore it has been excluded from the financial obligations, financial liability. Now take this example. Abhishek deposited 5 lakhs in the State Bank of India. Now, please interpret it whether it's a financial asset, financial liability or equity for the State Bank of India. Deposit of cash is a financial asset for Abhishek. Abhishek deposited a cash into State Bank of India. Now, please apply the definitions. For the Abhishek, it is cash deposited in the bank. It's a financial asset. If you go to the another one also, contractual right to receive cash, he has got, he can withdraw his cash from the bank, contractual. And the State Bank of India has got a contractual liability to obligation to deliver a cash to the Abhishek. Contractual right of Abhishek to obtain a cash is that for financial asset. A bank is equally a financial liability for State Bank of India. Bank has to pay money back to the Abhishek whenever he wants. It's a contractual obligation to deliver a cash. And therefore, for Abhishek it is a financial asset. For State Bank of India it is a financial liability. Now, see this example. And it's very important this example because such type of example may appear in the exams. And which we talk at that time, I say that to issue their own equity shares. Entity own equity shares, whether they are financial liability or a financial or there is a equity. In this example, we will see that what is a financial asset, what is the financial liability and what is the equity. L Limited sold goods to M Limited for 10 lakhs on credit. The payment will fall due on 31st December 2014. L Limited sold goods. Means if it has sold goods to M Limited, for L Limited it becomes a debtors, for M Limited it becomes a creditors. As per the purchase agreement, M Limited will issue an adequate number of own equity shares to settle the obligations. Because M Limited will show it as a creditors, because it's for a creditors 10 lakhs rupees. When L Limited sold goods to M Limited, for L Limited it is debtors. For M Limited in general sense, it's a creditors. What we are doing nowadays? It's a creditors. But he said that the M Limited says that okay, on the date when the due date is 31st December 2014. He said on this date, I have no cash, I will pay you. M Limited will issue an adequate number of own equity shares to settle the obligation. On 31st December 2014, M Limited will issue its own equity shares to settle this 10 lakhs. Own equity share to settle this 10 lakhs. How many equity shares? It says that to settle the obligation, adequate number of equity shares. It has not mentioned number of equity shares it will issue. It's an adequate number, sufficient. It can be more, less. How many? It's variable. It's variable, not fixed. The number will be determined. What will be the adequate number of equity shares? The number will be determined by dividing the amount due 10 lakhs. Amount due is 10 lakhs by market price of M Limited shares on 31st December 2014. Suppose on 31st December 2014, the market price of M Limited share is 50 rupees. Its par value, nominal value may be 10. Market price of shares of M Limited in the market is 50 rupees. So what it will do? How it will settle on 31st December 2014, which is the settlement date? What it will do? It has to pay 10 lakhs to M Limited. It says that I will give you adequate number of shares. And what will be that adequate? The number will be determined by dividing the amount due. Amount due is 10 lakhs by market price of M Limited shares on 31st December, that is 50. So number of shares which you are going to do is 20,000 shares. 20,000 shares will be given by M Limited to L Limited. So instead of giving 10 lakhs, it issued its own equity shares. M Limited issued its own equity shares. M Limited should recognize the payment due to L Limited. Now, see the case here. As far as now there are two parties. One is L Limited. L Limited. There is no issue with the L Limited. L Limited is showing it a debtors of 10 lakhs in its books of account. Is showing a debtors. The problem is with the M Limited. Whether M Limited, because it has promised to issue equity shares to L Limited on the date of the settlement. And how many shares? Not fixed. Variable number of. It will be calculated like this. So the question is whether M Limited will show it as a liability or will show it as an equity, the 10 lakhs. Whether M Limited will show it as a liability, liability means as creditors, or will show it as an equity share capital. We have to apply this test. What is the liability, financial liability, and what is the equity? You see, if it is a case that M Limited will calculate the number of shares only on 31st December 2014, which is the settlement date, then as far as the L Limited is concerned, who is receiving the shares on that date, he is indifferent whether he get 10 lakhs rupees in cash or whether he get a 10 lakhs rupees in shares, because both has got the same value of 10 lakhs on that date. So he will be indifferent on that date. He will be indifferent also on, suppose these goods were sold on 1st July 2014 and this they say on 31st December 2014 I will give you a number of I will make you payment in shares, and number of shares will be determined by the on 31st December 2014. L Limited will not have, he will not be influenced by this one. He says, yes, I will get 10 lakhs, nothing else, nothing more. So, on the date of settlement, the M Limited is giving its shares, instead of giving a cash currency, they are giving it shares. So, shares are being used as a currency, and there is no difference about that, whether they are equity or something else. Equity are being issued and being treated just like a currency. And therefore, in this case, M Limited, it show it as a creditors. It's an obligation because it is a contractual obligation to pay cash or other financial assets. It's a non-derivative contract. And if you go back, we say that if contract is non-derivatives to settle the own equity shares by variable number of shares. Even it may be derivatives, because value of shares will vary when they sold the goods, or number of shares will, the price of shares will vary on 31st December 2014. It's may be derivative contracts, but the L Limited will not get any benefit of this equity. What is equity? Equity is a residual. Whether it will participate in the residual? No. It will get the same amount of 10 lakhs of rupees by shares, not by cash, but he can't get more or less. If he can get more or less, then certainly it will be a residual. But if he gets the same amount, then it will be a liability. So in that case, L Limited will sell. L Limited will certainly show it debtors. M Limited will show it creditors. And when it issue the shares, then they will debit the creditors. Equity share capital account will be credited, and if any amount, some amount will go to the premium amount, although security premium. So in that case, what it says, M Limited should recognize the payment to L Limited as a liability, although the obligation will be settled by issue of equity shares. What we should not confuse that the M Limited is issuing a equity share, so it is a equity capital. No, it will be a equity capital on 31st December 2014 when you are issuing the shares, not before that. On issue equity share, the liability will get extinguished and equity in the books of Limited will increase by the corresponding amount. So it's a liability. Dear student, suppose this example changes. So in that case, M Limited will increase the corresponding amount in this in the equity. But suppose we change this example in different way. The goods were sold, suppose on 1st July 2014. The amount payable, because L Limited sold 10 lakhs of goods on credit to M Limited, and the amount will be, this 10 lakhs will be paid by issue of shares by M Limited, own equity shares it will issue. On the date of sale, the value of equity was rupees 50, or suppose it was 40, and they fixed that okay, I will be paying you 10 lakhs in the form of equity, and price of share of M Limited on the date of sale, that is 1st July 2014, is 40, means it will divide it by 40. It says that I will issue you 25,000 shares on 31st December 2014. Now, if this is a case, it is different than the earlier one. When it is dividing this 10 lakhs by the price of the shares on the date of settlement. On the date of settlement, that is 31st December 2014. Whereas in this case, the number of shares is fixed on the date of sale itself, that is 1st July 2014. Number of shares is fixed on the date of sale on 1st July 2014. Whereas in the earlier case, the number of shares was fixed only on the date of settlement. There is a difference here. As far as the L Limited is concerned, it is a debtors for them, no doubt. What about the M Limited? M Limited has fixed the number of, it has fixed the shares, fixed number of shares, fixed amount. Fixed amount is how much? 10 lakhs. Amount is also fixed and number of shares are also fixed. It is fixed for fixed case. It has, in fact, it has received in advance at 10 lakhs rupees for issuing 25,000 shares. It is the advance receipt of share application money, which will be allotted on 31st December 2014, but everything is fixed. Number of share is fixed, amount is fixed. And in that case, M Limited will show it as an equity shares. It will not show it as creditors. What entry will pass? The M Limited will pass on 1st July 2014. It will pass entry purchase account debit to shares outstanding. Equity shares outstanding means they have to issue 20,000 equity shares. If they are outstanding, that is a 10 lakhs rupees. And equity share outstanding is nothing but advance application money received, and that will be shown in the equity portion of the shareholders' money, and it will not be shown the liability. In the earlier case, when the settlement and the price, the amount is being divided by the market price of share on the date of settlement, it was treated as a liability up to that date, and after that it becomes equity when they have issued the shares. But here, M Limited will show it as a equity on 1st July 2014 on the date of sale itself, not on the settlement date. So it becomes an equity on the entry will be passed will be different by the M Limited in this case. So dear student, I think that you will be understanding the difference between these two. Because you see, take a case of a promise, you may understand better from the angle of L Limited. L Limited sold the goods on 1/7/2014, and on that date, M Limited say, I will give you 25,000 equity shares on 31st December 2014. On that date, on the date of sale, the price of the equity share of M Limited was 40, and that's why the M Limited promised 25,000 shares. Now it is fixed now. It will give it on 31st December 2014. Then L Limited will look, and he will always watch the price of the shares of M Limited from the 2nd of July. He will see what is the price today. Tomorrow, he said the price on 3rd of July 2014 becomes 45. Then how much he will receive? 45 multiplied by 25,000 shares. Next day, the price of shares went up to 50. He will get more. Means he is sharing the residual. He is sharing the residual. Amount is not fixed. What is fixed is the number of shares. The L Limited has an interest in equity now. The L Limited is not looking at from the angle of debtors or the liability or asset. This is the asset which has got a different market value every day. Maybe on the date of settlement, the equity share price went up to 60. So how much he will be getting? 25,000 multiplied by 60, 15 lakhs. Whereas he sold the goods of only 10 lakhs. He got 15 lakhs on that date. He is participating in the equity now, residual. And therefore, M Limited will show it as equity. For the M Limited, it is nothing but the advance application money received on 1/7/2014. So that will make a difference. And that is why we say that there is a difference between the equity and the liability. Now, in another example, sale advance a house building loan of 10 lakhs at a concession rate of 4%. Is it a financial asset for sale? Steel Authority of India advance a 10 lakhs loan to a concession rate to its employees. House building advance. The loan. Whether it's a financial asset for the sale? Certainly yes. Because what is the definition of the financial asset? It's a contractual right to receive cash. Sale has got a contractual right to receive cash. Receive cash means this 10 lakhs rupees along with the interest of 4%. So it has a contractual right to receive cash. Certainly it is under financial assets. It comes within the definition of financial assets. Now that is the, I have just covered up to this time what is financial instruments. It includes financial assets, financial liability. What is financial asset? What is financial liability? Distinction between, in one of the example, we have distinguished that it may be a financial liability or it may be equity sometimes. So this is there in the up to this time. Now we will see the debt equity classification. Till this time we have covered what is financial assets, financial liability. We have just given some discussion on the equity, but now I will clearly tell you what is the difference between the debt and equity as per the Ind AS 32. What are the factors which distinguish a financial liability with equity? Because equity also comes in the liability side of the balance sheet. So sometimes it's very confusing. What is equity? What is liability? And there is a clear distinction we have to make because there are different rules of accounting measurement for the equity and for the liability. And we have to be very sure whether it's a liability and which rule we have to apply to the liability. If it is equity, different rules applies. Now, the factors which distinguish between the liability and equity, the existence of contractual obligation. That's the first one. Contractual obligation. That is the first factor which distinguish the liability with equity. Contractual obligation for the issuers. Suppose the X Limited issued 1 lakh equity shares for rupees 10 per share, means 10 lakhs on 2010. It received 10 lakhs rupees. It will put it in the equity share capital. Question arises whether there is a contractual obligation to pay 10 lakhs to the equity shareholders. Contractual obligation. Dear student, as you know that equity shareholders' money is not repayable during the lifetime of the company. And there is no contractual obligation to repay 10 lakhs rupees. And if it is not, then it's not a liability. Because for liability, there has to be a contractual obligation to pay cash or another financial asset. That's the definition of the liability. And therefore, if there is a contractual obligation to pay, it's a liability. If it is not a contractual obligation to pay, it's a equity in that case. Now, the another characteristics of the equity is it represents a residual interest in the net asset of the issuer. Residual interest means, take a case for the equity shareholders, they are not repayable during the lifetime of the company. At the time of liquidations, what happens? First, all outsiders will be paid, and then whatever is left, it is paid to the equity shareholders. Whatever is left means residual. Whatever is left means residual. Paid to the equity shareholders. That residual may be more. Suppose equity share capital which they received from the shareholders was 10 lakhs. But only 4 lakhs is left, it will be paid to the equity shareholders. Suppose 20 lakhs are left, it will again pay to the shareholders. So, equity shareholder has got a residual interest. There is no contractual obligation to pay a certain amount to them. So, that's the basic difference between the liability and the equity. Represents a residual interest in the issuers, shares, options, warrants. These are all equity. These are all equity. Shares, options, warrants. Option implies stock options. Warrants, which will be converted into equity shares. Warrant is nothing but the advance money which you received. So these are all equity, and they will not be paid back during the lifetime. Rather, they will be paid only at the time of liquidation, and that is also not the same amount, maybe less or more. Now, the another features which we have discussed, now we can put it here. Does the issuer potentially have an obligation to settle gross in cash or variable number of own shares? Please recall that example of M Limited and L Limited. They issued 10 lakhs of 10 lakhs. L Limited sold the goods of 10 lakhs to them. Does the issuer potentially have an obligation to settle gross in cash or variable number of own shares? When we say the variable number of shares, because at the time of the sale on 1st July 2014, number of shares were not fixed. They were variable. It will be fixed only on 31st December 2014, which was the settlement date. So, or in variable number of own share? Yes. If it is yes, then it is a liability. Means when the settlement, the variable the number of share was fixed on 31st December 2014. Please recall what I told you. M Limited will show it as a liability. And if it is another way around, will settlement only the exchange of fixed number of shares to the fixed amount? Means on the date of sale 1/7/2014, it was decided that 10 lakhs will be paid by 25,000 shares. The number of shares were decided, it was fixed. Amount was also fixed. What was fixed? 25,000 shares. What was the amount? 10 lakhs rupees. If it was so, then it is equity. Then it yes, it is everything was fixed. Both were fixed. Fixed number of shares, fixed number of amount, fixed number of amount 10 lakhs, fixed number of shares 25,000. It was fixed. Yes, it is equity. So that's the way how we have to distinguish between the equity and the liability. Now, the preference share, as I have already explained to you, the preference share, it is a liability or equity, component, principal amount or dividend, and I explained to you that if it are redeemable preference shares, they are the liability, they are not the equity, because it's a contractual obligation to pay the cash to the preference shareholders. Dear student, we have discussed, what we have discussed? Financial instrument includes financial asset, financial liability, equity. All these three components of the financial instruments. Now, but we have now maybe the mixed one. There may be some compound financial instrument. Compound means it's a mixture of equity and debt. Mixture of equity and liability. Then what we do? The examples are convertible debenture, convertible preference shares. Convertible debenture, you must be aware of this word, convertible debentures. Means that you have issued debentures, or suppose in 2010 you issued as debentures of 10 lakhs rupees. The debentures were 10,000, 100 rupees per debenture, 10 lakhs rupees. And you have given an option to the debenture holder, you can convert within 3 years, each debenture will be converted into 4 number of equity shares. So it is a convertible debentures. Option lies with the equity shareholders. If it is compulsorily convertible debentures, compulsory, mandatory. If it is compulsory convertible debenture which were issued in 2010, 10 lakhs rupees of debentures, what will happen in that case? Number of shares are also fixed. Because they are 10,000 debentures, for each debentures they will issue 4 equity shares. So 40,000 equity shares they are going to issue for 10 lakhs. Both are fixed. Amount fixed, equity number of shares fixed. So in fact, if they are compulsorily convertible debenture, they are not the liability then, they are the equity. But if they are not compulsorily, if they are fixed, the option is given to the holder of the debenture holders, option is given. They are convertible at the option of the debenture holders. Then it is not fixed. Then it may be converted, it may not be converted. It's somewhat a compound financial instruments, which has got the characteristics of liability, which has also got the characteristics of the equity. Dear student, till today, as per our existing accounting standards, what is the treatment? Suppose these are the debentures which were issued in 2010 and they will be convertible before 2013 at the option of the debenture holders. So first we will show in 2010 these are the debentures and they are a liability. Debenture account will be credited and liability it will be shown in the liability side, liability portion. 2013 when they will be converted in the equity shares, from liability they will go equity. That is the way how we are treating at present this convertible debenture. But dear student, the scene will change when this Ind AS will be implemented for some of the companies from 1/4/2016. The Ind AS 32 says, or the IFRS says, they should be, if they have two characteristics, they are the mixture of equity and the debt. Debt and equity portion, please segregate. At the time of the issue itself, when you are issuing in 2010, 10 lakhs rupees, the holder has got the option to convert it, then it's a compound financial instrument mixture. And that mixture has to be segregated. What is the debt portion? What is the equity portion? Meaning thereby, at the time of the issue of 2010 itself, the whole 10 lakhs will not be classified as a debentures. Only portion of this will be the debenture, a portion of this will go to the equity portion, which we are not doing at present. So we have to segregate this 10 lakhs rupees in the debt portion or equity portions. The same will be the case with the convertible preference shares. Convertible preference shares. So that's and such type of questions appears in the exams. In this chapter, I told you in the very beginning that Institute of Chartered Accountant has written in their syllabus, your syllabus, that only the simple question, conceptual question will appear. No, you are not required to be expert in these chapters of financial instruments. But this type of compound financial instruments, questions have appeared a number of times in the past, 3-4 times. The answer of those questions will not change even after revision of these financial instrument chapters, because this portion is the same. There is no change in this portion, how to segregate between debt and equity portion. So for that purpose, you can very much do the past examination questions and rely on that. The answer is not going to change because of this revision of these chapters. Now this is the questions. In these questions, we will be showing you, demonstrating you, calculating you how in case of convertible debentures, where the option is with the share, with the debenture holders, how the debt portion, equity portion will be segregated at the time of the issue itself, and there will be a different this debt portion will be shown in the liability and accounting will be as per the liability. Equity portion will be shown in the equity and accounting will be as per that. So we have to be segregate debt and equity portions. Now the questions. Induga Limited has issued 5,000 convertible debenture with a face value of 100 per debenture. Interest rate on debenture is 5%. The debenture holders have the option of convening these debenture, converting. It is in fact is a converting converting these debentures into ordinary share at the end of the 4 years. Convert. They have an option. Option is important. They have an option of converting these debentures into ordinary shares at the end of the 4 years. The prevailing market rate for a similar debt which does not have a conversion option you can say better, conversion option right is 7%. What does it mean? A company, Induga Limited, has issued a 5,000 convertible debentures which has got a conversion option. That's why the interest given to the debenture holder is only 5% because they have a conversion option to convert these debenture into equity shares. In other case, if suppose there is no conversion option, if there is no conversion options, then such type of debenture being sold issued in the market at 7%. Why they are sacrificing a 2% interest rate on those debentures? Because they have an option for the option of converting into the equity shares. So that's the questions. I hope you have understood the questions now. And what you have to do, because it's a convertible debentures, option lies with the holders. We have to segregate how much of this, because at the time of issue it has issued a 5 lakhs rupees. 5,000 debenture of 100 is means 5 lakhs. When it made an issue, it got 5 lakhs. What is the entry we are doing at present? Bank account debit. Entry what we do at present is bank account debit 5 lakhs and to debenture 5 lakhs. But dear student, this will not be the entry now because it's a convertible debentures. Option lies with the holders. So bank account will be debited 5 lakhs. But this 5 lakhs debenture means it's a liability. It's a liability. Debenture means it's a liability. So we have not to show it all in the liability. Something out of this 5 lakhs, something will go in the debenture, something will go in the equity. It has to be segregated. And how it will be segregated, we'll be doing that questions. Basically, the comparison is that if there is no conversion option, then these debentures should have been sold in the market issued at 7% interest. Why 2% less interest? Because they have a conversion options. So now what is the method given in the Ind AS 32 to segregate this such type of conversion options? How much equity, how much debt? They have a certain methods. You may have got some other points, but please follow these methods because it has been agreed that segregation will be made on this basis. It says that suppose there is no conversion options. The debenture would have been issued at 7% interest. Present value, you might have received 5 lakhs. At the end of the 4 years, you have to make the payment of 5 lakhs to these debenture holders because if there is no conversion option, then it has to be redeemed after 4 years. So, what will be the present value after 4 years of that 5 lakhs? You have to make a payment after 4 years 5 lakhs. What is the present value? Present value will be certainly less. Because if you have to make a payment after 4 years 5 lakhs, if somebody says that I will pay you 5 lakhs after 4 years, you may say please pay me just like 3,90,000 and 80,000 right now. Instead of paying after 4 years, you pay me less amount today. Means present value of that payment which will be made, which will be received you after 4 years is less. So, what means less? You have got a certain discounting factors, and that discounting factor is a market rate of interest. And the market rate of interest is 7%. At the time that that 7% discounting factor, the present value of 1 rupees, present value of rupees 1, which you will get after 4 years is 76 paisa, 0.763. You can say 76 paisa. Instead, somebody say that I will give you a 1 rupee after 4 years. You may say, please give me 76 paisa right now. instead of paying after 4 years 1 rupees. So 0.763 is a discounting factor. You must be knowing how to compute it, because you have a number of questions here, or in your strategic financial management you are doing a present value computation in the capital budgeting and all these one. So it's a present value of 1 rupee today, and which is payable after 4 years. So 5 lakhs multiplied this, but it is at the rate of discount is applied 7%, not 5%, which is the market rate of interest. Then it comes 3,81,000. What else? If it is not convertible, then you are paying 25,000 annually on these debentures. 25,000 annually means 25,000 this year, 25,000 next year, and 4 years you will be paying 25,000. That's nothing but an annuity. And value of that annuity is 3.387. What is the meaning of 3.387? That you also can compute. It will be computed like this. And meaning of interpretation is like this. Suppose I tell you that I will give you every year 1 rupees, 1 rupee this year, 1 rupees next year, 1 rupees next year, 1 rupees next year. In 4 years I will give you 4 rupees, but every year 1 rupees. You may say, no, please give me in lump sum today. And that what will be that amount of lump sum today? That will be 3.387, 3 rupees 38 paisa around. Instead of 4 rupees you are getting over 4 years, the present value of that 1 rupees annuity every year is 3.387. That is again at a discount rate of 7%. And the present value of those which you are paying in 4 years, 25,000 per annum, that comes to 84,675. The total of this plus this is 466,175. Dear student, this is nothing but the contractual obligation to pay cash. These two portions is contractual obligation to pay cash. And contractual obligation to pay cash is a liability. And you have got 5 lakhs now. You have only contractual obligation to pay cash is 466,775. If they would have not been a convertible debenture, you would have a contractual obligation to pay cash on the 466,175. They have got this present value. You will be paying, in fact, 5 lakhs plus 25,000 per annum means 6 lakhs rupees, but the present value of that 6 lakhs rupees which is paid after 4 years 5 lakhs, and every year 25,000 in 4 years is a 4,66,175. And this is the contractual present value of contractual obligation payable over 4 years. Contractual obligation to pay cash is liability, and therefore it is a liability portion. You got 5 lakhs from issuing these shares. The present value is 5 lakhs because you got today 5 lakhs. Out of the present value of 4,66,175 is a debt portion. So balance portion, this is a balance amount. Balance portion is a equity 33,825. Out of 5 lakhs you deduct 466,175, 33,825 is a equity portions. So dear student, that's the way how we segregate. This segregation is not different. It has appeared in past in 3-4 examinations. Please do those questions. There is no change in these questions. The answer will remain the same because due to revision, there is no change in this portion. So these are the type of question which was appearing. So no change in that one. You can rely on the past answers of such type of questions. Now we shift to derivatives. Dear student, certainly you must have learned these chapters in your strategic financial management in a very detail. So I will not be covering it so hard, but anyhow I will just explain it. What is derivatives? Derivative has got a characteristics. It has got a underlying items. It has a very small or no investment in the beginning and settled at a future date, that are derivatives. And the examples are forwards, swaps, futures, options. These are the derivatives. Because the name derivative means it derives its value from the underlying item. That's the meaning of derivatives. Here we are talking about the options now. There is a small examples here. This is called a call options. You must have done in your strategic financial state management call option, put options. Here it is a case of a call option. Option is a derivative because this option derives its value from the underlying transactions. And in this case, underlying transaction is a foreign currencies rate. Now, I just read the questions. Purchase call option. On 1st August 2015, X buys a USD call options for covering its import transactions at a strike rate of 45.50. It's an option, not a forward. In case of option, the person who is buying, X has got an option. It has no obligation. But from whom the X buys this call option, that fellow has got the obligations. So, in case of option, one party has got an obligation, another party has got an option. Both haven't got an option, otherwise how it will be settled? The expiry date is 3 months, 31st October 2015. The premium is 30 paisa on the call. Gain or loss on the expiry at the various level of exchange rate is demonstrated by pay of table as under. You see the strike rate is 45.50, means on 1st August 2015, Mr. X says that because he must have to pay after 3 months, he might have imported some amounts, say for $1 lakh. X has imported on 1st August 2015, $1 lakh goods. And it has to make a payment after 3 months means 31st October 2015. It requires $1 lakh. It feels that the dollar rate will fluctuate and the dollar will get more stronger. Today rate may be less. Tomorrow it will go up after 3 months and then it will cost him very high and its costing will increase. So to avoid this exchange rate fluctuation risk, it buys a call option from the market. And the call option is of 45.50. It's an option. Means it has got an option. Suppose on settlement date, that is the 31st October 2015, that's the expiry date. Dollar prevailing in the market, dollar market rate is suppose 50. And it has to make a payment of $1 lakh. When it has to make a payment of $1 lakh on 31st October 2015, if it goes by market rate, it has to buy at rupees 50 in the market, then it has to pay 50 lakhs. But it has got an option, call option of 45.5. Certainly you say, yes, I will exercise my option, I will buy $1 from that fellow at 45 rupees 50 paisa, if it has got call options. So any rate which is more than 45.50, it will exercise its call option. If rate is less than that, suppose in the market when the date 31st October 2015, the dollar is being sold and market price is only 44, it will not exercise call options. Because you say in the market it is available at 44, why should I pay 45.50 to that fellow from whom I have purchased this call option? So that's the advantage of options, because they have got a certain strike price and you have got an option. So they have plotted here some of that. If they suppose, let's say the market price on the 31st October 2015 is 44.50, will it exercise its call options? Will it exercise its call options to purchase from the market or purchase from that fellow? Yes, certainly. What it is going to do? Because market price is 44.50, your call option, what is that? To import transaction at a strike rate is 45.50. It has in the 45.0, because what it says that it has to pay premium of 30 paisa, because to purchase this call option they have to pay some margin money, that is the 30 paisa per dollar for this call, 30 paisa. So if they have to pay for $1, 30 paisa call options, so 45.50 he is not, because if suppose in the market the 45.50 is there, the dollar market price is 44.50, it has got a call option of 45.50, whether there will be a loss or gain in that case. Suppose you go to the extreme one, 46.50. In 46.50, that's the market price. It exercise price or call is 45.50. It is more than this. No, it will exercise its call option, because it will get, at least if it exercise call option, then he will get a dollar at 45 rupees 50 paisa. Instead, if he does not exercise, he has to purchase from the market at 46.50. In that case, it will exercise and he will gain 70 paisa. Because in any case, 30 paisa he has to pay, or that he has already paid, that will go. Whether you exercise or not exercise, 30 paisa gone. Here you will be getting 1 rupees benefit, net benefit is 75 paisa. In case of 46, net benefit is 20, and up to this point of the strike price, the loss is only 30 paisa. He will not exercise the options. Why should he exercise the option of purchasing the dollar at 45.50 when it is available in the market at 44.50? No exercise of the options. So 30 paisa, whatever he is paid, is a loss to him. After that, once it goes more than 45.50, the market price goes, he will exercise the options and he will get this much of benefit. The reverse is the case of a put options here. He said that he buys a put options. Here is a put options, means he will sell. It's a case of export. He has exported some goods on 1st August 2015. He will get $1 on 31st October 2015, maybe $1 lakh on 31st October 2015, and he will sell in the market of those $1 lakh on 31st October. He feels that market price of dollar may come down on 31st October. I should purchase a put option. Put option means to sell. बेचने का option. I can sell it at that price. So it's a reverse of that call option, and then you will find the reverse one is going on. So you can just go through this one in the just reverse direction. So these are the examples which I have given to you about the call and put option. This is another example of derivatives, and please go through that examples. I am not going to do much on that account. You have very much done your strategic financial statements. And now we come to the embedded derivatives. Means there is a one derivatives. There may be one host contract. Within that there is some derivatives. Derivative inbuilt. Embedded derivative is a component of hybrid contract. Also includes a non-derivative host contract. The example is X company holds a convertible debenture of Y company, which is are convertible in equity shares. So what is the host contract? Is a debentures, and embedded derivative is a conversion option, which we talked last examples when we segregated this equity portion and the debt portion. The conversion option is an embedded derivative within the convertible debenture. Convertible debenture itself a host contract. Within that there is a derivative within it, that is the call options, and that conversion options, and that conversion options is with the holder of the debentures, and that is called conversion option is embedded derivatives. Now these are the some of the we are turning to the another one, that what is not covered within the financial instrument is this one. And I don't know, we should not bother much about it, and we will go ahead with this one. It's just for your academic purpose, because the what is important is that the financial instrument, not the Ind AS 132. Now I come to the another. Now it is a financial assets, financial liability, and the equity. Now the question is that why we have segregated these three. They are different rules of measurement recognitions. First we come to the measurement, because the recognitions rules depend upon some other thing, where there is a change in this one. In fact, there are no change in measurement also, but there are change when this chapter is revised before revisions. The recognitions and the classification were different. So, but measurement rules are almost the same. What is the measurement? What it says that at initial recognition and entity initial recognition, entity shall measure trade receivables at the transaction price, that fair value. You see, this transaction price is basically put in the Ind AS 115, and you should not bother much about it. For your purpose, you can say at fair value. On initial measurement, all other financial assets shall be measured at its fair value. Dear student, this is the change here. In our existing accounting standard, everywhere the initial recognition is measured at a cost. But here initial recognition itself, initial measurement is itself at fair value. And it's a fair value accounting. Generally, we must have purchased those financial assets and financial liability at fair value, and they will be their face value also. In practice, there may not be much difference between the cost and fair value at an initial one, but it is at fair value. We have to ensure when you are initially measuring the financial instrument, they have to be at fair value. Plus or minus in the case of the financial assets or financial not at fair value through profit or loss, transaction costs that are directly attributable to acquisition. There are certain financial assets or financial liability which are the initially every financial assets or financial liability initially recorded at fair value, but subsequently they are carried in the balance sheet either at fair value or at amortized cost. If they are carried at fair value subsequently, then the transaction cost is not added or subtracted from it. Added when you are purchasing it, subtracted means when you are taking a liability. In case of a financial liability, it will be subtracted. In case of financial asset, it will be added. That is in case of the fair value, in case of the financial asset or financial liability which are carried in the balance sheet at fair value, transaction cost will not be added or subtracted. But if it is carried at amortized cost, the another one, it will be added or subtracted. The transaction cost will be added, means if you have purchased a certain debentures for rupees 10,000, you paid a brokerage of 500, then it is a 10,500 will be the fair value at initial stage. Because that will be carried at amortized cost. If it is carried at fair value, then initial fair value will be 10,000 only. Transaction cost of 500 will not be added in it. So that's the meaning of the measurement. Subsequent measurement, as I told you that after initial recognition, entity shall measure a financial asset or financial liability in accordance with its classification. And here the change is. The classification has changed, especially in case of financial assets. There are no much change in case of financial liability, but there is a change in case of classification of financial assets. That's where this chapter there is a change. But as far as the measurement is concerned, subsequent measurement, that remains the same. So that's why I am again emphasizing that the question which has appeared in the past, they have appeared either the compound financial instrument, they have appeared either of the concession loan given to its employees, financial asset. The solution will not change in that case also. There was a questions about the derecognitions of financial assets and financial liability. There is no change in derecognitions principle also. So therefore, please do whatever in the past papers or compilations you are given, the answers are almost the same. The most changes in case of a classification of financial assets. Classification of financial assets. There is a here I invite your attention to these portions. Financial assets shall be classified and measured at amortized cost, fair value through other comprehensive income, or fair value through profit and loss account, or both. And there will be three types of financial assets. Financial assets carried at amortized cost in the balance sheet. As I told you that initially every financial asset will be recorded at fair value. Subsequently, they will be carried either at amortized cost, one classification. They will be carried at fair value through profit and through other comprehensive income. And dear students, because we have no concept of other comprehensive income at present with the existing accounting standards, so I advise you to leave this for the time being, because either you will get confused now, because we have no concept of other comprehensive income as yet, and we have no Ind AS 1 which defines the other comprehensive income. So I will not explain it much. But there is another classification, fair value through profit or loss on the basis. Fair value through profit and loss. This will be the one classification. Another is amortized cost. Now, how do we do these classifications? That depends upon entity business model of managing the financial asset and contractual cash flow characteristics of the financial asset. These are the two criteria on which basis the financial asset is categorized, either at amortized cost, whether it will be carried at amortized cost or it will be carried fair value through profit and loss. What it says, the entity business model for managing the financial asset. Entity business model for managing the financial asset. Contractual cash flow characteristics of the financial asset. Dear student, it may look very complicated, very high. You may not be understanding it. What is a business model? How do we understand this business model? But dear student, for your understanding, I will give a simple example. What is this business model is? You may not be understand why we find it difficult, because such type of capital market may not be present in India. Take a case, one bank has given a loan of 5 lakhs at 10% interest to Mr. C on 1st January 2015. Now, what is the bank business model? It says that it will collect, this loan has got a period of 3 years and the last installment may be on 31st December 2017. 3 years will end on that date. What the business model the company, this bank has got? Business model to manage this is a financial asset, loan is a financial asset. What is the business model to manage this financial asset? The business model is that the bank has given a loan on 1/1/2015. It will collect the principal of 5 lakhs within 3 years. It will also collect the interest of 10% within 3 years, whatever on the outstanding amount. This is the business model. Now, you go to another business model. This is one type of business model. And if this type of business model is there, then it will carry this loan at amortized cost in the balance sheet. But there may be a different type of business model also. What is the business model? That 1/1/2015, the bank has advanced a loan of 5 lakhs to Mr. C, one of the customers, at 10% interest. Tomorrow in the market, maybe after 6 months, the interest rates comes down. It comes down to say 9% or 8%. You have a loan of 5 lakhs on which you will get an interest of 10 lakhs, 10%. Now, after 6 months, say on 30th June 2015, interest rates comes to 8% in the market. But this is the loan which will give you a 10% income. If you advance a loan on 30th June 2015, that will give you a 8% interest. Now this loan has a more fair value in the market. People would like to purchase this loan, 5 lakhs, they would like to purchase at more price, which is 5 lakh 10,000. No doubt, sir, I can pay you 5 lakh 10,000 more than the principal amount. If bank sells this loan on 30th June 2015, it would like to sell it. Its business model is to earn its income not by the repayment of interest or repayment of contractual amount of principal. It earns its cash flow by selling this loan. It has originated this loan. It will trade this loan whenever its fair value goes up. Now the fair value of this loan has gone up on 30th June 2015 because the market rate of interest has come down to 8%. Fair value of this loan will certainly more than rupees 5 lakhs. Now, if it is more than 5 lakhs, this bank will sell this loan to another bank or another bank, maybe the X bank. It will sell at rupees suppose 5 lakh 20,000. Because why that bank is purchasing at more than its nominal price? Because it says that it will get a 10% interest. If I give a 5 lakhs loan, 5 lakh 20,000 loan, that bank will think that they will get 8% interest. So it will get a more interest. So this fair value of this loan has increased in the market. This bank has got a business model that it will earn its contractual, it will earn its cash flow by selling this loan, not by repayment of getting a contractual repayment plus interest over 3 years. No, they can sell this loan anytime whenever the fair value increases in the market. So it has got a different model. That is means they are holding this financial asset for trading. So they have a different model to collect a cash flow. Whereas in the initial case, the model was that it will collect its cash flow within 3 years. During the period of 3 years, it will collect 5 lakhs back. It will collect 10% interest. And up to the maturity period, and it will not sell it. So there are two different business models. If there is a one business model where the bank thinks that I will collect the cash flow in 3 years, I will not sell it. In 3 years, I will collect back this 5 lakhs principal amount, collect back this 10% interest on this outstanding amount. This is one business model. If it is a case, then this loan asset will be carried in the balance sheet at amortized cost. If this is the loan which is held for the purpose of trading, then it will be carried at fair value. So the classification will depend upon the business model and the contractual cash flow characteristics of the financial assets. Contractual cash flow characteristics, there is a principal plus 10%. Here the contractual cash flows in the case of a trading is maybe the fair value. The fair value. It has nothing to do about the repayment of 5 lakhs and the interest amount of 10%. It is basically the characteristics of the cash flow is a fair value, and therefore it has a different contractual characteristics of the cash flow. It has a different business model also. So therefore, the classification will depend upon the type of business model, managing the financial asset, and the characteristics of the contractual cash flow. Characteristics of contractual cash flow. This is the word which we will be using. This is a case of a business model. So these two things will decide the classification of the financial assets. After initial recognition, entities shall measure a financial asset, financial liability in accordance with these classifications. So what are the classifications which I have already told to you? A financial asset shall be measured at amortized cost if both the conditions are satisfied, which I have already explained. If the business model objective is to hold a financial asset to collect contractual cash flow or give rise to a specified date to cash flow, solely payment of principal and interest only, then I told you that it's at amortized cost. And if the financial model is another way around, it will be carried at amortized cost. If that is the two conditions satisfied, payment preponderance only principal and interest. Interest is consideration value of time value of money, and prepayment extension option may qualify. So that this is at amortized cost. The next if it is not that, as I told you that if it is for the held for trading, then it will be at fair value. Now the question is, what is amortized cost? How it is computed? Under Ind AS 109, amortized cost is calculated using the effective interest rate method. Effective interest rate method inherent in the financial instrument at the rate exactly discount the estimated cash flows associated with the financial instrument through the expected life of instrument, where appropriate, shorter period to the net carrying amount of initial recognitions. You see, you have given a loan of 5 lakhs in 2010. It will be collected in 3 years in 2013 along with the interest rate of suppose 10%. So whatever amount you are going, what will be the future cash inflow? The first cash outflow is 5 lakhs. Inflow will be 5 lakhs plus interest of 10% on the outstanding amount. If you discount those cash inflows, whether of principal or interest, at the 10%, then the present value comes to 5 lakhs only. That means the 10% is effective interest rate. If you recall, in your strategic financial management paper, you must be doing this in case of a capital budgeting, and that is called IRR, internal rate of return, and this is what exactly is the effective interest rate, which exactly discount the future cash inflows. That effective interest rate is which exactly discount the future cash inflows, and the net present value becomes the amount of initial recognitions. Initial recognition is 5 lakhs, the financial assets. So whatever the future cash flows come, if you discount it by the certain interest rate, and that exactly comes what is the cash outflow at the beginning, initial recognitions, then that is the effective interest rates. So it is impliedly it is IRR, internal rate of returns. So that is the effective interest rate, and we calculate the amortized cost using the effective interest rate methods. We will have some questions on it. Classification of financial assets shall be measured at fair value. I told you that either at amortized cost or the fair value through profit and loss account or comprehensive income. And for the time being, I am leaving this portion because you have no concept of the other comprehensive income. Now we will go to the fair value through profit or loss. Financial asset other than those measured at this one at amortized cost shall be measured at fair value through profit and loss. However, an entity may initial recognition irrevocably designate a financial asset measured at fair value or to eliminate a significant accounting mismatch. Entity may also make an irrevocable elections at initial recognition. So you need not bother about much because it becomes complex for you to understand. But the simple thing what you have to understand, which I have already explained to you, If that loan, they are holding it to get a contractual cash flows of the principal and the interest, it will be carried at amortized cost. That is the financial asset carried at amortized cost. Another category is carried at fair value through profit and loss. That will be in case of it has an intention of trading that financial assets, then it will be at fair value through profit and loss account. That's the simple thing what you have to keep in mind and you have to understand. Now this is the diagram by which you can understand. It's a business model test, contractual cash flow test. Amortized cost, if it is satisfied, then it will be amortized cost. If it is not satisfied, then fair value through profit and loss account. Reclassification required when business model changes. Certainly it will be, if your business model changes, then you have to reclassify the assets. But we are concerned with this one. If it is satisfy both the condition, then it is a amortized cost. And then certainly we will be talking later at stage of impairment also. If it is held for trading, as I told you, it will be carried at fair value. And fair value through profit and loss means any change in fair value at the reporting date will be debited or credited to profit and loss account. That's why it is called fair value through profit and loss. Fair value through profit or loss, because any change in fair value of these assets on the reporting date will be debited or credited in the profit and loss account. Not held for trading, it will be through the OCR. I again advise you not to do this OCR because it may be difficult to understand it. Debt investment, basic loan features, held to collect a contractual cash flow at amortized cost, fine. Held not to held at contractual cash, fair value through profit and loss account, which I have already explained to you. That's a simple way you can understand. Debt instrument with immediate derivatives, so you have to maybe segregating or not segregating. I again leave this one because it may make the things complex. Now, this is the one type of question which has appeared in past, and this is the case of a financial assets. Financial assets of loan at a concession rate to the employees. Then how it will be treated? Please do remember that financial assets are initially recorded at fair value. Financial assets are initially recorded at fair value and carried in the balance sheet either at amortized cost or fair value through profit or loss. There are only these two categories you can concentrate. So we have to see first initially recorded at fair value. If any financial asset is not at fair value, we have to compute the fair value of that financial asset. It will be carried amortized cost. We have to compute amortized cost in the subsequent measurement. And this is the case of, and which has appeared number of times in the exams in the past. If such type of questions if you solve, there is no change in the solution of these questions. I read it. PQ Limited grants rupees 10 lakhs loan to its employees on 1st January 2008 at a concession rate of 4% per annum. Loan is to be repaid in 5 equal annual installments along with the interest. Market rate of interest for such loan is 10% per annum. At what value of loan should be recognized initially and also calculate the amortized cost for all the subsequent 5 years. Calculation of initial recognition of amount of loan that will be discounted. Now the question is that, first thing that we will please leave this portion first. But what it says that PQK Limited has granted a 10 lakhs of loan to its employees on 1st January 2008 at a concession rate of 4% per annum. Now the question is that it's a concession rate, it is not a market rate. Now what is our principle? That it has given a 10 lakhs of loan to its employees. This is a financial asset and this has to be initially recorded at fair value. Now the 10 lakhs of loan is at concession rate. Certainly it has not 10 lakhs, its fair value is not 10 lakhs. If the market rate of interest is 10%, it must have been given at 10%, then fair value would have been 10 lakhs. But if you are giving it a 4%, then fair value will be certainly less than 10 lakhs. Our problem is that our principle of in the financial asset is that initially the financial asset will be recorded at fair value. So 10 lakhs is not the fair value. 10 lakhs is not the fair value on 1st January 2008. In spite of the fact we have given 10 lakhs to the employees as a loan, but that is at 4% interest, whereas in the market rate of interest is 10%. We have to compute the fair value. That's the first thing. Then, because in this case, in this financial asset, the business model is like this. The company PQ Limited will collect the principal 10 lakhs, this 4% interest till its maturity. Maturity is 5 years. So, its business model is to collect the contractual cash flow in a specified period. It has no intention to sell this loan. Therefore, this loan will be classified as financial asset carried at amortized cost. Financial asset carried at amortized cost. So that will be the as per this business model and the test of contractual cash flow. Contractual cash flow collections. Characteristics of that current contractual cash flows. So that we have decided. Now the question that how the entry will be passed. For that purpose, we have to compute initial fair value of this 10 lakhs, then calculate the amortized cost. We will be solving it. I will show you the solutions, how it will be derived. I will explain it. So, dear student, now what was the questions that the PQ Limited has given a loan of 10 lakhs at 4% interest, whereas the market rate of interest is 4%. Here there is a little bit of the corrections I would like to tell, because there is written 1/1/2008, whereas it is 1/1/2016. Instead of 8, you please take it 16, and then according to that. That's only case of the year change. Nothing else. Balance is the same one. Now, first what you have to compute the initial value of that 10 lakhs. Why? Because the principle is that initially this financial asset will be recognized at fair value, and 10 lakhs is not the fair value. We have to compute a fair value of this loan of 10 lakhs. And how do we compute? We have to compute that, because the question says it will receive a loan principal amount in 5 installment of 2 lakhs, 2 lakhs, 2 lakhs, 2 lakhs, 2 lakhs in 5 years. It will receive the interest at the rate of 4% on that case. The interest of the 10 lakhs, the first year 4%, 40,000, then loan becomes 8 lakhs, then 32,000, then it becomes 6 lakhs, 24,000, then it becomes 4 lakhs, 16,000, and the last year it will be 8,000. So these are the future cash inflows that we are going to receive. Market rate of interest is 10%, so we will be discounting these future cash inflows by this 10% discount factors. So to compute its initial fair value. Because the effective interest rate is 10%. And I told you that how do you compute the fair value by an amortized cost by applying the effective interest rate methods. So these are the future cash inflows from this loan of 10 lakhs, which will be repayable in 5 years along with the interest of 4% on the outstanding amount. Now the amount will be 2,40,000 in first year, 232 and 224, 216 along with the interest. Now at the 10% discount rate, factor for the first year is 9.09090, 82637512. These are the discount factor which will be given you in the exams. Otherwise you can compute in your calculators. You know how it has been calculated. The first one, it will 1.1.11 divided by this, then it will give a 0.9. Then again whatever will be, then you divide it by 1.1, then it will give you a 0.8263 like this. But generally it is given in the exams. Now discounted value at this, if you multiply 240 with 0.90, then it 218, this multiplied by this is this much, and these are the present value of these future cash inflows. Now the present value of these future cash inflows, which is an installment plus interest at the rate of 4%, is 8,54,762. And this is nothing but the fair value of this 10 lakhs loan given on that date. Initial fair value. Why it is, as I told you in the beginning, it will be a less, because it is you are giving it at a concession rate to its employees. So initial fair value will be 8,54,760. Means you will pass an entry first, staff loan account 10 lakhs, bank account 10 lakhs as usual. But because it has to be recorded at fair value, this 10 lakhs is not fair value. Fair value is 854. So we have to pass another date, another entry on at the same time, staff cost account debit to staff loan 145. You deduct 10 lakhs minus 145, this will give you 854,762. The difference between these two is this staff loan has to be credited by this. Ultimately, the staff loan would be at this value 854,762, which is the fair value on the date of initial recognition. So that will be done. And see the difference of this 145,762 will go to the staff cost. This is an expense in the beginning. So that will be the much difference when these NDS will be implemented. Now, as the fair value of this will be initially recognized, the balance amount will be debited to the staff cost. That's correct. Now we have to, now this is the business model of this particular financial asset. What is that? It will collect its contractual cash flow, that is the principal plus interest at the rate of 4% over 5 years. The characteristics of contractual cash flow is that principal plus interest, nothing else. No, it will not get anything less or net more. So it qualifies to be carried at amortized cost. Suppose if the PQ Limited has intention to sell this loan, after initial recognition it wants to sell this loan in the market, then it is held for trading. Then its business model is to do trading in the loan. And it will collect its cash outflow not from repayment of the loan or the interest, but it will collect its cash outflow by fair value, by selling the loan at fair value. So characteristics of contractual cash flow will change. Therefore, in that case it will be categorized at fair value through profit or loss. But in this case, it qualifies for carrying at amortized cost in the balance sheet. Now, how do we carry? Initially, we will recognize at 854,762 at the end of 2016. I again repeat, it is not 2008, what was given in the questions. It is 2016, first year. Now, at the end of 2016, it will be carried at this amount. We will be computing now the amortized cost. Now the computation of amortized cost is this. Computation of amortized cost. Computation of amortized cost is now this, because we have decided this is the financial asset which qualifies for and classified as carried at amortized cost. Now we have to compute the amortized cost. How it will be computed in the first year? First year it will be computed, initial value of the loan is 854,762. We will apply the interest at effective interest rate methods. Effective interest rate methods. 10% on 854,762. The interest comes 854,760. What will be the entry of 85476? We will debit the loan account, credit to the interest account. Now, we will receive the repayment of 2,40,000. It may include 40,000 as the interest, but we don't classify it as an interest. It's a repayment. Because interest will be applied at an effective interest rate, that is 10%, that we have done. Whatever the amount is coming, whether it is on account of interest or the repayment, we deduct it just like this. Because interest we have already credited to the interest account. Now, for 2,40,000 when we receive it, entry will be bank account debit to loan account. And this is the opening 854,762. You will add 85,476 in it plus and minus 2,40,000, and that will give you a figure of 7,238. That is the amortized cost in the beginning. So that is the way we are going to calculate every year. This will become an opening, apply 10% interest, whatever amount you receive, deduct it, and this is amortized cost. It would be done like this. This is the way. This type of question has appeared 2 times in the past. As I told you, the answer of this question will not change. It will not change. So you can very much refer the answers of solution of in the past papers of such type of questions. Entry will be staff loan account debit to interest, and then when you are receiving bank account debit to staff loan, and the interest on the staff loan account debit to this will go to the profit and loss account. These are the repetitive entry you are going to pass at the end of the every year, and at the end of the 5th year it will become nil. It will become nil. So that's the way how you have to carry the financial asset at amortized cost and how to compute amortized cost. So that's the way how we have to do it. Discuss the classification of financial liability. We have discussed the classification of financial assets. An entity shall classify all financial liabilities and subsequently measure at amortized cost, except for initially the financial liabilities will be recognized at fair value. Suppose you have issued a certain debentures. They are not convertible debentures. If they are convertible, then you have to do the liability portion and the equity portions. The liability portion which you compute, that's the initial fair value of that one, and it will be recorded at that value. If it is non-convertible and the interest rate which you are paying on it is exactly the same, then that will be also the initial fair value of that liability. After that, it will be carried in the balance sheet either at amortized cost or it may be fair value through profit or loss account, just like I told you in case of the financial asset. Financial liability, what it said, entity shall classify all financial liability and subsequently measure at amortized cost. It will be at amortized cost. Generally, financial liability are at amortized cost, except financial liability at fair value through profit and loss account. When transfer of non-qualified recognition, when the continuing involvement approach apply, financial guarantee contract. First is the finance fair value through profit or loss. Either at amortized cost or fair value through profit or loss. Financial guarantee contract will also be carried at fair value. Commitment to provide, these are all at fair value. At fair value, this will be at fair value. This contingent consideration at 1038, this will be at fair value, and mostly they are carried at amortized cost. So these are you have a very simple thing here. Financial liability either at amortized cost or at the fair value. That will be the simple way how it will be done. These are the classification of the financial liabilities. All liabilities either amortized cost, or if there is a mismatch which will say then it will maybe carried at fair value basis. Held for trading, then fair value through profit and loss account. For the time being, you can concentrate on these two portions. You need not to concentrate much on this one because that becomes complex in this sense because we have no OCI concept at yet, and to make it understand will be difficult, and we may leave for the time being for the May 2016 exam this concept. Hybrid liabilities are fabricated. Hybrid means compound financial instrument, which I have already explained to you, and no reclassification is permitted after that one. So generally the financial liabilities are carried at amortized cost except those fair value through profit or loss, financial guarantee, commitments, these are carried at fair value. Now, recognition of dividend income, which I have already explained to you. Dividends are recognized in profit or loss and entity right to receive. This is same principle. What is it when the dividend is recognized under the IFRS? Because this dividend recognition is not given in the Ind AS 115. Now it is covered in the 109. Here Ind AS 109. So the principle of dividend recognition is same as we are having in AS 9. So entity right to receive dividend. It is probable that economic benefit associated with the amount of dividend measured reliably. That's the recognition of dividend here, and the simple as good as AS 9. Financial liability, fair value, and own credit, and that I think that you should leave it because that will make the thing more complex because what your syllabus says, the ICS says that only the conceptual simple thing will come, not this complex thing. So it is better to leave and not advisable in that at present. And I will just give you the idea about the hedging. It may be looks complex. I don't advise you to do the practical questions on it, but please understand the concept. It may come as a short notes to you. What is hedging? Hedging means you want to protect yourself from some risk. It's a protection from the risk. To minimize your risk. That's the hedging. Entity use a risk management techniques called hedging, whereby the entity tries to reduce the impact of future potential losses, cost or losses. Hedging is shelter oneself from the danger, risk in response to etc. So just like you see, take for example that if there is a company which has made an import on 1st January 2015 worth rupees 1 lakh worth of $1 lakh. In $1 lakh they have imported certain goods from USA. On that dollar 2015 dollar was of 60 rupees per dollar. It has to make a payment on 31st of March 2015. This entity feels that when we will make a payment of $1 lakh on 31st March 2015, dollar may rise, it may go anywhere. May go to 65, may go to 70 on 31st March 2015. Market rate may be so. So you have to pay more money and more rupees at that time for that $1 lakh. It wants to hedge yourself. Means it wants to minimize its losses. Say, okay, 1 lakh today is equivalent to 60 lakhs. But I have no money to pay. So I am not paying as 60 lakhs. But I want to pay it by after 3 months. That will be on 31st March 2015. But what will be the amount? Suppose the dollar goes to 70 rupees per dollar, then what will happen at that time? It has to pay 70 lakhs. Its cost will go up. It wants to minimize the loss. It is ready to give more than 60 lakhs on 31st March 2015. But it don't want to give the market rate on that date because it may go to 70, it may go to 72 and there will be maybe a huge loss. It want to minimize that loss. And therefore, suppose then what they will do that 1/1/2015 the entity, the company will go to the bankers and I have to make a payment on 31st March 2015 of $1 lakh. How much what will be the price of the dollar at which you can give me on 31st March 2015? It will ask to the bankers. Bankers say, okay, I can give you a dollar on 31st March 2015, the $1 lakh to you on this date when you are going to make payment at the rate of 62. Means he has to give 62 lakhs rupees to the bank and bank will give you a $1 lakh, then you make a payment of $1 lakh. Now, this 2 rupees loss is there. Okay, but he is ready to bear that loss because he is sure now he has minimized the loss to only to 2 lakhs. If the dollar on 31st March 2015 goes to 68, market price on 31st March 2015 goes to 68, but it will buy the dollar from that bank at 62 because it has got a forward contract with them, with the bank. Bank has to give at the rate of 62. It's a contract, not the option. So bank has to give, he has to take. Market rate of interest is, exchange rate is 68. If you would have not booked this forward contract, it has to pay 68 lakhs. So it has minimized its loss of 2 lakhs. Instead of 8 lakhs, it has minimized to 2 lakhs. So that's what it is. This is called, this forward contract of rupees at the rate of 62 is called a finance, is called a hedging instrument. It is called hedging instrument. And this $1 lakh which he has to pay after 3 months is a hedge item. It's a hedge item. It has hedged this item through this hedging instrument. So these are the two terms. Hedge item, 1 lakh. Hedging instrument, forward cover of 1 lakh. These are the two things. One is called a hedging instrument, another is called hedge item. Now, hedging, now we are talking about the hedge accounting. Hedging and hedge accounting are two different things. You may be doing hedging, but you may not be doing hedge accounting. You may be doing hedging, but not doing the hedge accounting. The hedge accounting is an optional thing. You have booked a forward cover, you have under the AS 11, you have a certain accounting for forward cover. There is a different accounting of forward cover under these financial instrument chapters, which is based on Ind AS 32, 109 and 107. It has a different accounting. We are not going to that one. It is based, because the derivatives, it has to be carried at the fair value in the balance sheet. So it's a hedging and hedge accounting. So hedging is, I have explained to you, in this case of import transactions, the hedge item is 1 lakh liability of $1 lakh. Hedging instrument is that you have purchased a forward cover of 1 lakh at the rate of 62 rupees per dollar. That's a hedging instrument. And this way it is called hedging. You have hedged your risk, you have minimized your risk to 2 lakhs. Maximum 2 lakhs risk will be there, loss will be there, not more than that one. But in spite of doing this hedging, you may not be following the hedge accounting. Hedge accounting is optional. And to follow that hedge accounting, you require to qualify and fulfill certain conditions for it. And it's not optional, it's not automatic. It's not automatic. Why it is not automatic? Because this hedge accounting is a different type of accounting other than the normal accounting. And to do something abnormal, to allow something abnormal under the accounting principle, certain inbuilt check has to be done. And there is a, in this Ind AS 109, for doing the hedge accounting, they have prescribed a certain conditions. And they are nothing but the check and restriction on the entity whether to do the hedge accounting or not. Because it has a certain, it is, this option of doing the hedge accounting comes with certain restriction. So that's why this hedge accounting is not very much prevalent here, because it has so many conditions to put on that one, and it's not an open option to anybody else. So you may be doing hedging, but hedging will be done and you may be doing it, but the normal accounting will be followed. If you choose to follow the hedge accounting, then you have to qualify it for, you have to satisfy certain conditions. Hedge accounting, therefore, is a technique that changes the normal basis of accounting to recognize gains and losses associated with the hedging instrument and hedge item. I have told you what is hedging instrument. In the example I have given, forward cover is a hedging instrument. $1 lakh liability is a hedged items. So that both are recognized in the profit or loss account in the accounting period. sometimes it happens that the loss on account of hedged item, maybe that what is the loss? $1 lakh, because when you are doing the forward cover, what the accounting system says that the hedge item of $1 lakh will be converted, restated on the reporting date. So any loss will go to the profit and loss account. You have a financial instrument, hedge instrument, its profit or loss may go to the another accounting year, because if normal basis of accounting is followed, it may go to another one. The purpose was that if there is a loss on the hedge item, there will be profit on the hedge instrument, and they have to come in the same accounting period so that it matches and the fluctuation in the profit and loss account is reduced. If this is the accounting, hedge accounting is an option to the entities so that they can do such accounting, which is called a hedge accounting, that profit or loss of the hedging instrument comes in the same accounting period of the profit or loss of the hedged items. Because hedging instrument profit or loss will be in the reverse direction as of the hedged item. If there is a loss on the hedged item, there will be a profit on hedging instrument. If there is a profit on hedged item, there will be a loss on hedging instrument. Only then they will become effective. Because hedging instrument is for to safeguard your interest. The loss of profit, loss on the hedged items. Loss on the hedged items. So that is not a normal basis of accounting, you can call it an abnormal basis of accounting. And that's why this abnormal basis of accounting comes with an option with certain restrictions. So you can do the hedged item and hedge accounting for recognized asset and liability, just like you have a liability. I told you you have to pay $1 lakh on 31st March 2015 for you have purchased of goods on 1st January 2015. It's a recognized liability. There may be recognized assets. You have exported an item on 1st January 2015 and you will get a payment on 31st March 2015. That's a financial asset which you have recognized in the books. Sales and receivables you will be recognizing. Unrecognized firm commitment, there are certain that because you have put a purchase order that I will buy the $1 lakh goods on 30th June 2015. Now on 30th March 2015, when you are closing the financial statements, you have a firm commitment to buy of $1 lakh. You may want to hedge this $1 lakh liability also, which is not in the books. It will come in the books on 30th June, but you want to hedge it right on the before 31st March 2015 because this you have given an order. Maybe suppose on 1st March 2015 you gave an order for that. It's a firm commitment. There is no recognized liability in the books of accounts. Still, you can have a hedge accounting for that. That is an unrecognized firm commitment. Forecast transaction. It is just like it's also a forecast transaction. When you say firm commitment, then you have got. But there may be a forecast transaction, but future cash flows. You can do for the forecast one also. You can do the hedge accounting and you can purchase the hedging instrument for the forecast transaction. You have to pay after 6 months this much of money to somewhere. There will be a cash flow outward, the dollar will go, then the dollar amount will be different, the market price will be different. You may be purchasing certain hedging instrument for that, then forecast transaction and net investment in the foreign operations. In fact, you will have three type of hedge. One is called a fair value hedge, another is called cash flow hedge, another is a hedge investment in overseas operations. These are the three types of hedge you have got. Fair value hedge, where you want to hedge the fair value, because the fair value of the asset will change. You have got inventories. Today its fair value is 5 lakhs. Maybe on 31st March 2016, its value may come down. Fair value may come down. You want to hedge yourself for decrease in the fair value. Decrease in the fair value. For that purpose, you can you can sell the asset. You can sell that inventories. You can enter in the forward contract to sell that inventories at 5 lakhs. So that you have an hedging. You have a forward cover to sell that item at 5 lakhs. So what you are hedging is a fair value of that inventory. Fair value of that inventory. There is a cash flow hedge where the exposure to expected cash flows are. You have to pay some amount in the futures, and today dollar is 60 rupees, tomorrow it will go to 65, the cash outflow in rupee term will maybe, which is today 60 lakhs, cash outflow will be 65 lakhs. You want to hedge this cash outflow. That's called a cash flow hedge. Cash flow. Any outflow, cash flows, you want to hedge this exposure of the cash flows. And if you have got a subsidiaries branch operation outside, then this type of hedge applied, net investment in overseas operations. For your examination purpose, I would suggest you, these are not mandatory what I am saying, but don't take it that it's what I am saying will not appear in the exam, but because it's February and you have to appear in the exam for May. So at the present, for the May 2016 students, I will like that you concentrate only on these two types of hedge. Maximum what will appear in the exam is the definition of these two hedges. So please go through only these two definitions, and you need not to worry much about the hedge accounting. So I am shifting and going ahead of this hedge accounting. Now I go for the derecognitions of the financial assets. The questions has appeared in the past about the derecognitions. Derecognition means when you remove the financial assets from your books of accounts. When you have got the, suppose it's a case of loan, when it will be removed, whether you have sold the loan or you have received the loan, only then it will be removed. Or it has become sure that the loan will not be received, it has become bad, then again you will remove it. And that is called a derecognition of the financial assets. This chapter prescribes the rules of derecognition, and sometimes maybe that as per the present accounting, you may be derecognizing certain assets, financial assets, but it may not be derecognized as per these rules of these chapters based on 109, Ind AS 109. The contractual right to cash flow from the financial asset expires, then you derecognize it. If you transfer the financial asset, you derecognize it, means you remove it from the books of account. Complete derecognition of finance. There may be three types of derecognition, may be complete, partial derecognition combined with the recognition of new liability. There may be three type of cases. And this type of questions has appeared in the past. Again, I would like to reiterate that if such type of questions have come in the past, there is no change in the solution of those questions also. You will completely derecognize the transfer, the financial asset when it is transferred, receiving an exchange of cash or other asset with no continuing involvement. This is the most important thing, no continuing involvement, then the full derecognition will be done. But if there is something continuing involvement with that, no derecognition, you might have sold it, but there is some condition attached that you will get this much of money because this way or that way. If there are certain conditions and your cash flow increases or decreases of those conditions which will be decided in the future, then you cannot do the complete derecognition of those financial assets. So these are the examples of the derecognitions of financial assets. Hilltop Limited sells a portfolio of receivables with a carrying amount of 1 lakh to Sun Limited for fixed amount of 90,000. Recourse with no recourse to Hilltop Limited in case of bad debts. Sun Limited assumes a full risk of collection which is reflected in debtors are notified, transfer, directed, loss control of assets,
and it assumes the full risk without recourse. This is most important. Hilltop Limited, if any of the debtors, the transaction is treated outright sale and asset will be de-recognized in full because there is no recourse. If there is a recourse, it says, no sir, I will pay you 90,000 if I will collect at least 95,000, then only then I pay. That is dependent on the future conditions. So whether it will receive 90,000, not less than 90,000, it depends upon the futures, that whether he collects 95,000 or not. So there is a continuing involvement with this one. There will be no complete de-recognition in that case. This 90,000 will be shown as a liability, 1 lakh in the asset, because it will not be de-recognized, and it will be done like this. So I have given you some or more example of this. You please go through those examples. You will better understand from this. If this is example of partial de-recognitions and how this will be done, and that is about this. There are certain examples of which has appeared in the past, and examples in your study module of the chapter 6. Please go through that example. 2 times the questions has appeared in past of the de-recognitions. So please go through those questions. Please solve it. I have in my books has given those examples, solved them in these new chapters, and that is book of the Student Guide to Accounting Standards written by me. I have also revised those chapters, finance instrument, given at the supplementary with that, and then lot of examples and lot of questions have been solved, but in case of de-recognitions, the questions answers have not changed because there are no change in de-recognitions principle there. Now we come to the presentations. There is a debt equity classification which you have already done. This debt equity classification we have done, compound financial instrument we have done. Now we come to the treasury shares. The treasury shares means here in India you can't purchase, any company cannot purchase its own shares. There is a buyback provision, it has to go through that one, but once you have buyback the share, then you cancel those shares. But in the other jurisdiction other than outside India, there are some countries where you can buy your shares, can hold it, can sell it later stage. So you can do the treasury, and that means you can buy, you can sell your own shares. You need not, when you are buying it, you need not to cancel it. So those are called treasury shares. But what is the accounting effect of that? It says that when you buy your own shares, you deduct out of your share capital less treasury shares. When you sell it, you add it to that one. You add it to that one. Any gain or loss on sale and purchase of treasury share is not recognized in the profit or loss. It is recognized in the equity itself. So you are just adding. Suppose you have a total capital of 10 lakhs. You purchase 1 lakh shares, then your capital 9. You sold this 1 lakh share later on at 1.5. Your capital will go to 10.50. So, but you don't recognize that you purchased it at 1 lakh, you sold it 1 lakh 50,000. The 50,000 is not a profit. It will not go to the profit or loss. That's the rules, accounting rules regarding treasury shares. Please go through this one because that may appear in the short notes. Interest, dividend, loss and gains. As I told, the interest is recognized as per the effective interest rate methods. Dividend is recognized on the right to receive basis. Losses and gains are also recognized as per the standard, the 109. Offsetting of financial assets and financial liability are not generally allowed. It is allowed only when that they have got a legal right to shut off this one financial asset to the financial liability, and they have the same characteristics. They have legal right, and they are arising of the same transaction. So you can offset it. Otherwise, offsetting of financial asset and liability is not allowed. As far as the disclosure requirements is concerned, I don't perceive that you will have a questions on this disclosure requirement, but please you go through what are the disclosure requirement of different things. Only thing what I like to tell you to prepare credit risk, liquidity risk, market risk, because as per the Ind AS 107, you have to disclose these three risks in your financial statement. So what is this credit risk, liquidity risk, and the market risk? Just for the purpose of short note, sometimes it comes, you prepare it. So what is credit risk? You are selling the goods on credit. There is a risk that you may not receive the money back from debtors. That's a credit risk. How you are measuring that credit risk, how you are managing that credit risk, how you are mitigating any credit risk, that the disclosure is required in the financial statement. What is the liquidity risk? That you should pay your liability in time. How you are managing your liquidity risk, that has to be disclosed. You have a money, you got 5 lakhs of rupees, which is payable after 3 months, you have to pay it back 3 months. But you have invested this 5 lakhs in one instrument, one asset, which can be sold only after 1 year. You have to make a payment of 5 lakhs after 3 months. You have invested in 1 year. So you will get a money after one year, but you have to pay in 3 months. How do you match this liquidity risk? There will be a risk of the liquidity. You may not be able to meet your liability on the due date. So liquidity risk disclosure has to be done, how you are managing it in the financial statement. In the market risk, there again it has to be disclosed. Market risk basically is of interest rate, price risk, and the foreign exchange risk. These are the three market risks for which the disclosure is required in the financial statement, how these risks are managed. Interest rate comes down, goes up. You have a floating rate of interest loan you have taken from the bank. The interest rate goes up, goes down, there will be risk on it. If it goes up, you have to pay more interest. You have a certain loan which is based on the floating rate. You have to, how you are managing that risk. Are you buying an interest rate swaps for it? Or what are you doing on that one? It has to be disclosed. Price risk. Your product is being sold in the domestic market, in the foreign market at a certain price. If the price fluctuates because there is a recession or there is due to the competition, if the price comes down by 5%, what will be the impact on your bottom line, that on the profit or loss? That has to be disclosed, and it has also to be disclosed how you are going to manage such type of risk. Exchange risk, you are exposed to the foreign currency risk because you are in the business of export, import. You have borrowed from outside, you have invested outside. You are exposed to foreign currency risk. How you are managing this foreign currency risk, how you are doing any hedging, how types of instrument you are buying, and that's you have to disclose whole management of this exchange risk in your financial statement. So that is what basically the risk disclosure in case of Ind AS 107 explained to you. This is one of the case study of the Australian Airlines. You please go through it. It may not be that much of relevant as I told you for your examination. Thank you very much for this, and I again tell you that whatever I have deliberated, it is with the view that you are appearing in the May 2016 exams and you are left only 2 months in between. So these are wherever you have delivered, please concentrate on those areas. And that will, I am sure you will be able to go through these chapters with these guidelines, with these explanations, and succeed in your exam. Thank you very much. Wish you all the best.